Last week, the Indian stock market fell by over 2%.
So on aggregate, we are looking at a closer to about 25% upside in the market.
On FY27 numbers, Nifty is trading at around 20 times. Now, this versus S&P at 22, 23 times.
The US Commerce Secretary, who actually said that the India-US trade deal was almost done.
And how will the market react thereafter?
The trade deal or the confusion regarding the trade deal has almost no impact on the Indian corporate earnings.
In your opinion, how should a long-term fundamental investor react? Hi, welcome back to Torch Investment Lab. Last week, the Indian stock market fell by over 2%. So today, we'll ask three simple questions from our Investment Lab experts, Vivek and Amit. 1. Is this fall meaningful? 2. What is Torch Investment Lab sensing on the US-India trade deal? And 3, the most important one, how should a long-term fundamental investor react in this circumstance? So, welcome Amit and Vivek. Yeah. So what's your view on the 2% fall last week? Vivek, please, over to you.
Thank you very much, Anuj. Delighted to be here. I think the way we look at it, it is fairly early days. While the first week of the year gives us a sense of the general flavor that that the investors are thinking about the market at the start of the year, and it could be sometimes indicative of sentiment, we would not read too much into it. And I think the biggest reason or rather the biggest factor that we see that is relevant for the market this year is a very strong earnings story and earnings recovery that we are seeing in the Indian market. Now, Indian earnings are recovering from closer to about 7 to 8% in fiscal 26 to more like 14 to 15% in fiscal 27. So as we go through the course of the year, we will actually see a very considerable earnings accretion, earnings acceleration uh, happening, and that earnings acceleration is being driven by a turnaround in the economic growth, which is robust. But the last few quarters, particularly in the wake of the GST cuts, we have seen a reacceleration in the economy. So a reacceleration in the economy and a reacceleration in the corporate earnings uh, makes us feel not to read too much in the 2% decline that we had in the first trading.
And Anuj, just adding a little bit in terms of the historical perspective. I mean, Nifty is up for last 10 years, every year. On an average, it has given us a return of about 12% in dollar terms, which if you look at in rupee terms, it's about 14-15%. So it's a market which has given very good returns over the long terms. It may look bad sometimes, but 2% down, 5% up, that's okay. But we should put it in perspective. I just wanted to leave that there.
Yeah, yeah. So Amit, looking at the market from the valuation lens, the Indian market was considered to be more expensive. And maybe the whole journey, as you said, over the 10 years led to that. So do you think these corrections that we are seeing right now usually reset the valuations?
Yes and no, because at the moment, if you look at Nifty, first to answer your question whether the market is expensive or not, on FY27 numbers, Nifty is trading at around 20 times. Now, this versus S&P at 22, 23 times. So, one, it's not as expensive as other markets. Another way to look at it is comparing Nifty versus, the other emerging markets. And one can see that Nifty's premium to the other emerging markets is at the lowest historically. So it is still trading at a premium. It's a very interesting market. It has got a lot of interesting companies, very high ROE businesses. And so there are various reasons why Nifty trades at a premium. But that premium is at the lowest it has ever been. And on an absolute basis, the valuation isn't very high, I think.
Just adding to what Amit actually said, if if you have been a fund manager and you have been actually looking at Indian equities for the longest period of time over the last 20 years, you do find that the Indian market does trade over 20 times earnings most of the times. That has even been the times when there have been trough in earnings for several years. That is, the earnings growth have been closer to 0%. The Indian market carries on trading at more than 20 times. So compared to its own trading history, the Indian market is not trading expensively.
Right, right, right. And coupling that you just said, Vivek, that we can expect the corporate earnings, to increase next year. So, Vivek, interestingly, part one of the AI economy that we did, it's on our channel. You did mention that the productivity of the Indian companies, and especially the Nifty 50 companies, would exponentially grow, and that because of the AI adaptation, because they will deploy AI in their systems, their productivity and margins will shoot up. You did mention that in our session when we were dissecting the AI economy, and today you have actually put number to that. Am I correct to say that?
I have just alluded to the fact that when we look at the consensus earnings expectation, so when all the analysts of the streets are actually looking at the companies that they track, they on average think that the earnings growth is going to grow closer to 14 to 15% based on their own expectations and based on what the companies have guided them. That 14 to 15% is fairly a deterministic view of what the analyst community thinks about the growth in fiscal 27, which is almost like calendar 26 for at least 9 months. So, the earnings growth picture is at about 14 to 15% on baseline assumptions, even without factoring in the artificial intelligence impact. Anything that comes on artificial intelligence in way of massive productivity, tailwinds will be surprises, positive surprises to these numbers. So there is an additional cushion that will come from artificial intelligence integration. Now, the thing about this thing is that this has has an impact. We have already started seeing the impact of artificial intelligence coming through in the US companies. We haven't heard as much about it as far as the Indian companies is concerned, but we do feel that it's only a matter of time. So during the course of the year, we will actually see an additional layering of AI benefits coming for the Indian corporates, but that should be on top of the mid-teens earnings growths.
Sure, sure. So, Amit, you manage funds all across the world. Therefore, so the last week, coming back to last week, the indexes went up in the Asian countries like Japan and South Korea and China, closer to 1%. It was a rise. So the fall does have a reason always to this. When the fall is of this extent, it does have a reason. So can you help us decipher the reason behind the fall of last week?
Okay, Anuj, first of all, I would go about talking about the rise in other markets. First of all, as Vivek caveated, first week of the year is not really, there are lots of forces going on, people are repositioning and all that, so you can't take it too seriously. That's one thing I would say. But second thing, what we've noticed when we look at our portfolios is that one of the large trade that has worked over the past 10 days is companies which are very focused or developing chips for the AI revolution. So when you talk about companies in Korea, it was Hynix, Samsung, who make DRAM and high bandwidth memory for AI. Those guys saw upgrades from analysts. Similarly in Japan, similarly in China, and similarly across the US. So there is an AI trade which has benefited some of these markets, specifically very large companies. In Taiwan, TSMC is the largest and the most important company in this AI ecosystem. So that's one reason why those markets may have gone up. Now, why has India gone down in this period? I think it's one, lack of the AI trade. You don't have enough companies which are in this space, which we alluded to last time. And secondly, I think it is just there is a lot of pessimism still. A lot of people were hoping that there will be a deal, on the tariff side that would have been announced, but that hasn't come through either. So there is a bit of lingering negativity in the market, which shows up in FII flows as well, which shows in other areas as well. But that's it. I would not read too much into it.
And just adding on to what Amit said, um, in the last week, there have been some important developments in the US, which are contributing to even further unease as far as Indian trade is concerned. There is a new act of US Parliament, or rather, act of the US Congress coming through, introduced by Lindsey Graham, the senator from South Carolina. This bill allows for the US president, based on his determination, to impose up to 500% rate of tariff on any entity, company, country, and sanction other individuals. Um, and gives a tremendous amount of discretionary power to the US president. In the context of where the Indian tariffs stand and the 25% punitive tariffs India has got because of doing Russia trade, this has created further uneasiness in the market. And the reality is that this bill is going to become, or rather, this proposed bill is going to become an actual bill in the next few days. And there is some chance this will provide some um, you know um, kind of a negative dampener sentiment for the Indian market, or at least some participants in the Indian market. uh, but the flip side to this is that if you actually look at India's actual oil trade with the with Russia, which has been the bone of contention for the US, it has been on a declining trend over the last 6 7 months. We compute that this number might have come down by as much as about 10%, if not more, in the last 5 to 6 months. And it is on a downward trajectory. At the same time, India's imports of US oil have been on a very rapid upward trajectory as well. So the Indians have much to show to the United States that that they are adhering to the sanctions, and the various Indian entities are reducing or completely eliminating their trade in sanctioned Russian oil. And so while the market may fear that these 500% tariff powers with the US government or with the US president could be something detrimental, the reality on the ground is that the bones of contention between the United States of America and India are becoming less and less significant. And India has much to show to the US that it is importing much from the US. So this again provides a more a more important point as to why we will eventually reach a trade deal and why the sentiment will.
Yeah. So, Vivek, that was very interesting, but I would love it if you could summarize as to what signals is our investment lab catching regarding the US India trade deal. You have mentioned, but if you could just summarize it in point wise, please.
I think the trade signals that we are actually finding, as far as which are relevant for the India-US trade deal, are as follows. India's imports of Russian crude oil have materially come down from the from June, July 2025 to December 25. Per some research companies, this magnitude might have even come down by about 25 to 30%. This is a confirmed data point that we are finding. Another data point that we find is India's import of crude that is coming from the US has materially gone up. And it appears that India is consuming something like 15% of its daily, million barrels of fuel consumption that it does from the United States. So that is a confirmed data point. Third data point that we actually came was actually something that came from Howard Lutnick, who's was the U.S. Commerce Secretary, who actually said that the India-U.S. trade deal was almost done, and pending some political resolutions, it has not been signed so far. The fourth data point that we actually get is from Indian Commerce Secretary, Mr. Piyush Goyal, who has been actually saying that the points of a dispute or the points of contention between the US and India have been narrowing, and he's very, very optimistic of a trade deal coming through. He's made this comment over last, several weeks, and perhaps a couple of months, but that is itself being said and is reassured. So, in summing it up, the progress that is happening as far as the crude situation is concerned, of that India adhering to some of the sanctions that the U.S. has put, India's trade improving with the U.S., a positive commentary coming from Mr. Howard Lutnick, and positive commentary coming from Mr. Piyush Goyal. All of these are important data points, and I think very significant as we start.
Right, that was very interesting and very promising actually. So, Vivek, what do you expect? Will the trade deal be announced one fine day and we will get enough, or we will get enough signals to expect the deals? And how will the market react thereafter?
How we think this will actually pan itself out. What we think is that the corporate earnings story and the reacceleration of it and the reacceleration of the economy is the most important thing for the market. That is the one that will actually decide the significant upside that we will see in the markets. We think it is the single most important factor that will determine the outcome. The trade deal or the confusion regarding the trade deal has almost no impact on the Indian corporate earnings. Let me give you in magnitude terms. The total amount of trade that India does with the United States of America, total exports, are somewhere in the tune of closer to about 120 billion. And India imports something to the tune of about 80 billion. And there is a fiscal, or rather, trade deficit of close to 40 billion. $40 billion is something to the tune of 1 percentage point of India's GDP. Or in equivalent terms, if you were to say in terms of corporate earnings, it would not be more than 1 to 2% of total contribution to India's corporate earnings. Right? It is very, very small. So if your earnings growth picture is growing by 14%, and tariffs related backlash is causing your corporate earnings to get impacted by 1 or 2% or maybe 3%, you still see a very healthy earnings growth. So the corporate earnings picture is extremely positive. That is is the most important thing. The trade related uncertainty is giving us better and better entry points to get into the market. So if this uncertainty actually, increases, and we think the chances of this uncertainty increasing are fairly low, but it is entirely possible that there could be a few things that, increase a little bit of uncertainty for a couple of weeks, and the markets come down even further. We think we are actually going to have even better entry points from a longer term investment. But the conditions as they stand today, 16% of, let's say, 14 to 15% earnings growth probably give an earnings potential of 14 to 15% for this year. Amit said that we are trading at a lower valuation, that maybe about 10% to 22 times where it normally is. That can give another 10%. So on aggregate, we are looking at a closer to about 24-25% upside in the market. Now, if the market was to come down even further, maybe 4-5%, that probably would mean that there's even bigger upside of maybe up to 30% for the market. So the trade related uncertainty is a reason to buy the market, not to keep away from the market.
So, Vivek gave us a perspective regarding the trade deal, the corporate earnings, and the EPS. Amit, would you like to share your opinion on the FYI flows? Because that is another concerning thing to our investor community.
So Anuj, interesting point. FIIs last year sold close to about $14 billion in Indian equities, but they bought about $5 to $6 billion of Indian bonds. So net there was still an outflow, but that is it's much less and it's not as negative. Now, why are FIIs selling? I mean, one is the trade uncertainty. I think definitely that's a factor. But more importantly, India was going through a cyclical downturn in earnings troughed somewhere in the June, July quarter, and then started to accelerate a little bit along with government announcements of GST cuts and loan growth picking up. So we are seeing that cyclical trough reached and things starting to accelerate a little bit. But FIIs are looking at a slow economy, and tariff related uncertainties and things like that, and maybe that's one of the reasons they are selling. But if I look at the longer term, again, we've dealt with FIIs, we've been FIIs in India for a period of time. They are not usually short-term players. And when we start looking at a longer-term picture for India, you see a very positive trend. You've got a very stable government. You've got an economy which is going to grow from the 4.2 trillion currently to 25 trillion, 20 trillion in the next 20-25 years. It's got great deal of institutional and HR and people capital. The domestic inflows in the Indian market have more than countered these FII flows, which wasn't the case 5 years ago. So there's a lot of positives, if you look at the Indian market on the long term. So I won't be surprised if the FIIs start turning course within this year, over the next few months.
And I will just caveat and add a few more points to what Amit actually alluded to. The story of the Indian economy and Indian corporate earnings decelerating was a story of last year. The story of this year in fiscal 27 is of corporate earnings and growth actually re-accelerating. So that is one tailwind one headwind that will now turn into a tailwind. That is number one. Second, as Amit was alluding, the total amount of domestic capital formation that is happening and finding its way into the Indian market domestically is very big and is supporting the market. Thirdly, as far as foreign investments into India are concerned, in way of institution, the FII investments, there is a component in that which is of passive flows that comes from MSCI benchmarks, etc. Depending on the size and the liquidity of a particular economy and market. As the size of the Indian economy keeps on growing bigger and the liquidity keeps on improving with all the IPOs and second round offerings, etc., that is an automatic, passive flows that will come and keep on flowing positively into the economy. So we would say that perhaps if isolating the factors, the reasons of concern a little bit about the deceleration in the corporate earnings and maybe concerns about the trade war, etc., affected the market last year. Going forth, we think the improvement in the corporate earnings and resolution of the trade war will actually provide fresh impetus of FII flows into the country. On the latter half, even if the trade situation remains complicated for a period of time, through the course of the year and to next year, we think there is very low risk to the market. We think market will still surprise considerably on the upside on account of very strong corporate earnings.
Sure. So, what you pointed out is that the trade deal actually, when you look at the data point, is not a major effect on the Indian economy, but the sentiment behind it is huge. So, and you've also given us interesting data points about the how the resolution of the contention between India US regarding the Russian oil is evidently getting resolved. So, do you think we can expect a trade deal in the next 1 month?
We would say that as the corporate earnings picture becomes a little clearer into the quarterly earnings numbers that will come for the December quarter and subsequently for the March quarter, etc., the trade situation will become more and more irrelevant for the Indian market. That is, if the trade deal is achieved, well and good. But even if it is not achieved and it is taking, it matters very little for the Indian. It will be fine. Um, because you will have to go back to August to see the behavior of the market. The market did not fall off when the tariffs were put in a big way on India, or particularly the context of related to Russia of that additional 25%. Market took it in the stride. Uh, that suggests that it is not that the market is bothered too much about the tariffs, but it does affect short-term, day-to-day trading for a few days. But beyond that, it will just become a more irrelevant factor as we go through the course of this year.
Now we will get to the most important thing. In this environment, in your opinion, how should a long term fundamental investor react? Over to you, Amit.
I think this is a very good buying point. And as Vivek mentioned, if there is more weakness, even a better opportunity to buy. Because for the long term, if you look at the story, the earnings growth picture is very good. Valuations aren't expensive, and eventually there are certain. If you go one level into the companies, there were several factors which were holding back earnings in certain areas like banks. You had an HDFC Bank merger which they are consolidating, but eventually that will also show up in numbers. A lot of IT services companies, people are expecting very little benefit from AI. In fact, people are expecting them to be getting hurt with AI. We think it's different. And eventually what Vivek is mentioned is the only thing that will come through. The earnings are going to surprise on the upside, and the number the earnings growth is running at 14 to 15%, with valuations being very cheap. I think those are the main factors which will move the market, and you should be buying.
Just adding on to what Amit actually said, the question that you posed, that is, what is the opportunity for the investors? What is happening right now is that the wheat and the chaff are being harvested, are being cut at the same time, right? There is no discernment between the companies that are doing really well operationally and the ones that are probably not doing, etc. And as a result of it, there is a tremendous amount of opportunity that if you have actually worked on your companies and you have a good feel on the companies, etc., and their operational, prospects and how they're executing on the ground, uh, you know, uh, we think you'll be rewarded by picking those kind of companies and doing a research. It is a period of patience because there are days that are going to be volatile, days in which there are big falls that could happen in both in the market and individual securities. Uh, but when we actually look out and we think, when we look back, we will actually say that these were one of the best buying opportunities for the year.
And Anuj, just adding on to how we are using this as an opportunity, we have been looking at mid caps which have been growing earnings, which are growing at 25% plus, with their stocks falling. We are looking, and these are companies which we've analyzed. We looked at the management again, as Vivek said, individual businesses which you understand very well. So that's one opportunity set we are looking at. We are also using our AI algos to run on the Indian market to identify very good businesses and invest in them for the long term. So we're very active.
So one thing that has come out very clear is both our investment experts, Amit and Vivek, have clearly expressed that the real story is the earning, the corporate earnings going up, which is well been projected and documented everywhere for 2020-26. Rest, the trade deal will happen today or tomorrow. The contention point of the Russian oil, the data points are clearly saying that Indian import of the Russian oil is going down, and the Indian import of the US oil has seen a significant upsurge. So the trade deal is going to happen. We can infer that with all these data points. So it is a great entry point, as you guys just pointed out. The valuations are getting corrected. The earning story is way up. Thanks a lot, Amit. Thanks a lot, Vivek, for joining us. We really needed this clarity after the 2% fall last week.
Thank you, Anuj. Always a pleasure.
Thank you very much, Anuj.
Yeah. Yeah. So that's all this week from Torch Investment Lab editorial. Stay focused on signals, not noise. Cheers.